Hello guys, so the most awaited video is finally here. Now in this video I am going to be discussing with you 50 adjustments. These are those 50 adjustments where you often make silly mistakes. These are those 50 adjustments which are highly probable from your examinations point of view. These are those 50 adjustments which will really help you handle your question paper very smoothly, especially your first total income question. And see, I know I am taking precious time of yours from these 1.5 days. So I am not going to be covering simple, obvious, known, easy adjustments in this video, no, because you are already aware of them. So my target through this video, my whole objective is to discuss with you tricky adjustments, key adjustments, important adjustments, those adjustments where you actually need some help. Alright, I can guarantee you, you will have significant takeaways from this video. Let's straight away get into the adjustments. I'm going to go chapter wise, okay? First of all, starting with your basic concepts chapter. So if your assessee is a non-resident and if he owns a ship and if he comes to the Indian port, and let's say from the Indian port cargo, passengers, mail, livestock, all of these are getting loaded into the ship. So the non-resident is earning freight from India, guys. That freight into 7.5% will become PGBP. Now this non-resident has two options. Option number one, no postponing the tax payment till the assessment year. Either pay tax now itself and then only leave. That is understanding, pay tax in the previous year now itself and then leave. Or option 2, if you want to pay later, you make satisfactory arrangements and leave. Satisfactory arrangements mean, like for example, you appoint an agent and leave. So first point clear, if assessee is a non-resident, he has a ship and he comes to an Indian port, and in the Indian port, passengers, mail, cargo and all are getting loaded into the ship, which means the non-resident is earning freight from India. 7.5% of the freight will be deemed to be PGBP. On that PGBP, listen non-resident, either you pay tax now itself and then leave, or you make satisfactory arrangements and leave. Adjustment 1. Then comes your adjustment number 2. This is regarding senior citizen and super senior citizen. What I've seen is, as soon as we look at the age of the assessee, we try to conclude whether assessee is a senior citizen or super senior citizen. Please know that age is not the only criteria. You also have to look at the residential status, because only residents will be considered as senior citizen or super senior citizen. If you're a non-resident, I don't care about your age. You will not be considered as senior citizen or a super senior citizen. Only residents can be considered as senior or super senior citizen. Now remember, resident means what? Resident will include both ROR, RNOR, it will include both. Okay, second adjustment. Then comes your third adjustment, the most important adjustment, guys, section 87A rebate. Now this is different in the normal regime and different in the default regime. Let's discuss from the normal regime point of view first. In the normal regime, 3 conditions. Condition number 1, assessee must be an individual. Condition number 2, assessee must be a resident. And condition number 3, total income should be up to 5 lakhs. If all these 3 conditions are fulfilled, then in that case, assessee can enjoy a maximum rebate of 12,500 rupees. Individual, resident and income up to 5 lakhs. In the default regime, if you see, same first 2 conditions, assessee must be an individual, assessee must be a resident, but your total income should be up to 7 lakhs. If all these 3 conditions are fulfilled, assessee can enjoy a maximum rebate of 25,000 rupees. So guys, are you understanding that in the normal regime also, in the default regime also, your first 2 conditions are common. Assessee should be an individual resident, assessee should be an individual resident. The difference is that in the normal regime, your total income should be up to 5 lakhs, and in the default regime, your total income should be up to 7 lakhs. Okay, in the normal regime, your maximum rebate is 12,500. In the default regime, your maximum rebate is 25,000. Now see, you can enjoy rebate, but against which income assessee cannot enjoy rebate? Against section 112 ALTCG. Now see, I'll tell you, in this rebate concept, what mistakes students generally make? Number 1, they forget to exclude this. See, against 112A LTCG, you can't enjoy any 87A rebate. Under any regime, you can't enjoy 87A rebate. Against section 112 LTCG, you can enjoy rebate. Against section 112A LTCG, you cannot enjoy any 87A rebate. Point number 1. Okay. Then there is one more mistake that generally happens over here, and that is HUF. See, 87A rebate is only for individual. It is not for HUF. HUFs are excluded. Okay, these were 2 common mistakes. Now see, if assessee is following the default regime, total income has to be up to 7 lakhs. But what if the total income is more than 7 lakhs? If the total income is more than 7 lakhs, in that case, I will, follow these 3 steps. If after following these 3 steps, if I get a positive number, even though my total income is more than 7 lakhs, still I will have rebate. What are these 3 steps? First step is total income minus 7 lakhs. Let's take one example. Let us say that the total income of my assessee is 7,20,000. Okay, so your first step will be total income minus 7 lakh, which means what is your assessee's total income in excess of 7 lakhs. In our example, it is 20,000 rupees in excess of 7 lakhs. Then your second step is going to be basic tax. That is, on the 7,20,000 total income, what is the basic tax of your assessee? How will you compute? As per 115 BSc, guys, basic exemption limit will be 3 lakh. Up to 3 lakh, no tax. Then 3 lakh to 7 lakh, in between you have 4 lakh income, no? On that 5% tax, that's going to be 20,000 rupees. Then what is the income in excess of 7 lakh, 20,000 rupees? On that you will have 10% tax, which is going to be 2,000 rupees. So assessee will have basic tax of 22,000. So step 1 is total income minus 7 lakh, which in our case is 20,000. Step 2 is basic tax on our total income, which we just calculated is 22,000. Then you will do 2 minus 1, not 1 minus 2, 2 minus 1. Here 2 minus 1 is 2,000 rupees. So this number, this will become your 87A rebate. Now see, what if this number is negative? Negative number is possible, no, because you are subtracting. 2 minus 1, you are subtracting. So negative number is possible. What if you get a negative number? Then no rebate. Then no rebate, no relief, nothing. Okay, so this is your discussion with respect to 87A rebate. You understood, right? In the normal regime, income has to be up to 5 lakh. Your maximum rebate is 12,500. In the default regime, your income has to be up to 7 lakh and maximum rebate is 25,000 rupees. In the default regime, you have extra drama. See, all this you don't have in normal regime. All this is only in default regime. In default regime, even if the income is more than 7 lakh, still I will do these 3 steps. If I get a positive number, I will still have rebate. What are the 3 steps? Number 1, total income minus 7 lakhs, then basic tax, and then 2 minus 1. Simple, easy. Don't forget the 2 mistakes. Rebate is not available against 112A LTCG, and also if assessee is a HUF, in that case also rebate is not available. It's only for individuals, okay, individual residents. Then comes your fourth adjustment, which is about surcharge. Now, what is the maximum surcharge possible under the normal regime? Under the normal regime, it is 37%. Under the default regime, under 115 BAC, maximum rebate possible is 25%. But however, if assessee is having any LTCG, whether 112, whether 112, it doesn't matter, any LTCG, or if assessee is having 111A STCG, or assessee is having dividend income, for these 3 incomes, the maximum surcharge is 15%. The maximum surcharge is 15%. Now, what is a mistake that happens over here? I'll tell you. There are 2 mistakes, okay. Mistake number 1 is that students start thinking that, oh, for special rate incomes, maximum surcharge is 15%. That is incorrect. Because see, dividend is normal rate income, not special rate income. But for dividend also, the maximum surcharge rate is 15%. But however, if you see lottery income, betting income, casual incomes, they are special rate incomes. I don't have casual incomes in this list. So for casual incomes, there is no maximum limit on surcharge. The maximum limit on surcharge is only on LTCG, 111A STCG and dividend. Don't conclude it is for all special rate incomes. That will become wrong. Okay. The second mistake that students do is that, I don't know why, but many students think that this 15% maximum limit is only in the normal regime. No, it is common provision under both the regimes. Whether assessee is following the default regime, whether assessee is following the normal regime, doesn't matter. On these 3 incomes, the maximum rebate that is possible is 15% only. Sorry, the maximum surcharge that is possible is 15% only. Okay, this was your 4th adjustment. Then comes the 5th adjustment, the most common mistake in the examination, and that is rounding off. Every time ICI has those, they have these board of studies webinars, no, every time in the board of studies webinar, this point is highlighted that students are forgetting to round off. 2 numbers you are supposed to round off, total income number and tax number. You cannot think that your answer is over unless you have checked this point. Okay, rounding off 2 numbers, you will round off total income number and tax number. Don't round off income at each head of income. No, only round off your total income number and your tax number. Okay. Then comes your 6th adjustment. See, in case assessee is having any cash credits, unexplained incomes, unexplained investments and all, that is section 115 BBE incomes, then what will be the tax rate? See, assessee will have to pay 60% tax plus mandatory 25% surcharge plus 4% cess. Why am I using the word mandatory? Why am I saying mandatory surcharge? Because see, generally surcharge applies only when the total income is more than 50 lakhs. But this 50 lakh limit and all will not apply over here, guys. Doesn't matter how much is the cash credit. Even if it is less than 50 lakhs, still the surcharge will apply. Mandatory 25% surcharge will apply. Okay, so 60% tax plus 25% surcharge plus 4% cess. So effectively, assessee will have to end up paying 78% tax. Now see, in the examination, what mistakes happen over here? I'll tell you. See, if you're doing MCQ question, okay, then you can use 78% number, no problem. But if you're doing a descriptive question, if you use the 78% number, you will not get marks, because in descriptive questions, you get marks for steps. So you have to show these 3 steps, only then you will get the marks, okay. So be careful for cash credits, unexplained incomes, unexplained investments. For MCQs, okay, straight away you can do 78%. But if it is a descriptive question, then 60% basic tax plus mandatory 25% surcharge plus 4% cess. Okay, so these were 6 points from your basic concepts chapter. Now let's come to residential status. I have 5 very interesting adjustments to discuss with you over here. First is stay in India. See, when you're checking the residential status of your assessee, you will find the number of days assessee has stayed in India. No, so you know very well that the date on which your assessee arrives into India and the date of departure, both you will count as if he is in India only. Date of arrival, date of departure, both the dates you will count as if assessee is in India only. Everybody knows this. But what is the exception over here? The exception is CDC cases, that is continuous discharge certificate. This concept comes into the picture if assessee is a crew member of a ship. Okay, in that case, in the CDC, 2 times date will be written. Number 1, when the crew member enters the ship, and number 2, when the crew member exits from the ship. Now, whatever date is written in the CDC, you will exclude those dates. You will not count those dates as stay in India. Whatever date is written in CDC, when he enters the ship, when he exits from the ship, whatever date is written in CDC, you will not count it in stay in India. It will be excluded. Okay, this is your 7th adjustment. Then comes your 8th adjustment. This is regarding deemed resident. See, first of all, when do you think about deemed resident? Only if assessee is a non-resident, you will think about deemed resident. Now, in deemed resident, there are 4 conditions, okay? Condition number 1, assessee has to be an Indian citizen and not, see, we are not covering person of Indian origin over here. This is the most common mistake over here. So, in deemed resident, assessee has to be an Indian citizen. Condition 2, assessee has to be a non-resident. Condition number 3, from the total income, if you subtract income from foreign source, which means I'm talking only about income from Indian source, it should be more than 15 lakh rupees. And condition number 4, the assessee should not be liable to pay tax in any other country, which means assessee must be living in a tax haven, or assessee must be living in a country where there is no income tax. Okay, remember, in case the question is silent, you cannot assume this condition. You can say that this condition is fulfilled only if the examiner gives you some hint about this condition. Only then you can say this condition is fulfilled. So 4 conditions, guys. Assessee is an Indian citizen, assessee is a non-resident, total income minus income from foreign sources, that is income from Indian sources, is more than 50 lakhs, and lastly, assessee is not liable to pay tax in any other country. If all these 4 conditions are fulfilled, then assessee will be deemed to be a resident, and if he is deemed to be resident, he will be considered as RNOR. Now, for RNOR, what kind of incomes are taxable? Tell me. RNOR, number 1, all Indian incomes are taxed. Number 2, business incomes from businesses controlled in India, and number 3, professional incomes from profession set up in India. These are the 3 incomes taxed for RNOR. Okay. So this was your deemed resident concept. You understood the mistake that is possible, right? Deemed resident, person of Indian origin, I will not cover over here. Okay. Then comes your 9th adjustment, the place of accrual of salary, that is where does your salary income accrue. I have 2 rules over here. I have a general rule and I have an exceptional rule. The general rule is that salary income accrues in the place where your assessee is rendering services. Salary income accrues in the place where assessee is rendering services. But there is an exception. In that exception, there are 3 conditions. Condition 1, assessee must be an Indian citizen. Condition 2, employer should be government of India. And condition 3, assessee is rendering services outside India. But even though assessee is rendering services outside India, still the salary income, the allowances, the perquisites, everything will accrue in India. And after accruing in India, salary alone will be taxable. Allowances and perquisites will be fully exempt. And you know one thing, this exemption is there under both the regimes, under the default regime also, under the normal regime also. This exemption is there under both the regimes. Understanding, everybody? So salary generally accrues in the place where you are rendering services, but if these 3 conditions are fulfilled, then salary, allowances, perquisites, everything will accrue in India. But after accruing in India, salary alone will be taxable, allowances and perquisites will be exempt. Okay, now see, I'll tell you what mistake happens over here. The same point, guys, was tested in May 2024 mock test paper MCQ. Okay, so while correcting that, I noticed a lot of times in that particular MCQ, the assessee was Australian citizen. Okay, so students did not even consider that point. They just saw employer is Government of India and they applied this exception. They forgot to check assessee is not an Indian citizen. So if assessee is not an Indian citizen, this exception will not apply. If this exception does not apply, then the general rule only will apply. Okay guys, then comes your 10th adjustment. In the 10th adjustment, we're talking about this 15 lakhs calculation. See, just now we saw the 15 lakh calculation in a deemed resident point. This 15 lakh calculation is there in two places in your syllabus, guys. One is in special provision. To find residential status, if you want to apply the special provision, then this condition should be fulfilled. Total income minus income from foreign sources should be more than 15 lakhs. Okay, same condition you have in deemed resident also. Now in both of these places, when you're doing this 15 lakh calculation, you have to keep in mind one small point only. I'll tell you, easy only, listen to me. Total income minus income from foreign sources means what? It means income from Indian source. Income from Indian source means what? Generally, income from Indian source means one income only, that is income which is earned in India. But however, for this 15 lakhs calculation alone, income from Indian source will mean three things, guys. Not only incomes earned in India, we will also cover business incomes from businesses which are controlled in India and professional incomes from profession which is set up in India. Now here what mistake is possible, I'll tell you. Point number one, students start thinking, oh, same like RNOR. No, it is not same like RNOR. What is the difference? Here I am talking only about incomes earned in India. Am I talking about incomes received in India? No. When I talk about RNOR, for RNOR I will tax Indian income. Indian income means what? Earned in India, received in India, both will be covered. But here I am covering only earned in India. I am not covering received in India. Be careful. Okay, so when you're doing this 15 lakhs calculation, you need to calculate income from Indian source. For this, generally income from Indian source means income which is earned in India. But for this 15 lakh calculation alone, income from Indian source will be three things: incomes earned in India, business income from businesses controlled in India, professional incomes from professions set up in India. Simple, guys, all clear? Now come to the 11th adjustment about HUF residential status. See, whether the HUF is resident or non-resident, it depends upon the place where the HUF is being controlled and managed from. If the control and management is fully in India, or if the control and management is even partly in India, then we will say that our HUF is a resident. Okay, so when does your HUF become a non-resident? Only if control and management is fully outside India. Okay, now once your HUF is a resident, you have to check whether HUF is ROR or RNOR. That will depend upon the Karta. If the Karta fulfills the two additional conditions, fulfills both the additional conditions, then your HUF will become ROR. If the Karta does not fulfill even one additional condition, then your HUF will become RNOR. So if you are noticing whether HUF is resident or non-resident, it only depended on where is it controlled and managed from. It did not depend upon the Karta. But once your HUF becomes a resident, then whether it is ROR or RNOR, that alone is depending upon the Karta. If the Karta is fulfilling both the additional conditions, HUF is becoming ROR. If the Karta does not fulfill even one additional condition, HUF becomes RNOR. And did you notice? I am talking only about additional conditions. I am not talking about basic conditions. So whether the Karta is resident, whether the Karta is non-resident doesn't matter. Only thing that matters is whether the Karta is fulfilling the additional conditions or not. Okay, so these were your first 11 adjustments. I am hoping a lot of new points you're seeing through this discussion. Now coming to our agricultural income discussion, 2 points I want to discuss with you. Number one, the biggest problem in agricultural income is that we know partial integration method very nicely, but in the exam it doesn't even strike us that we're supposed to even apply this method. Okay, so remember one small rule. As soon as you see assessee is having exempt agricultural income, and if they're asking you to compute tax, you have to apply partial integration method. See, partial integration method is also called as the aggregation method. Okay, and this method is not going to influence your income computation. It will only influence your tax computation. So if assessee is having exempt agricultural income and if they are asking you to compute tax, then you have to apply partial integration method. But once you identify that okay, partial integration method is applicable, don't straight away start computing the steps. No, wait. First check these 3 points. Is your assessee an individual, HUF, AOP, BOY or AJP? Then net agricultural income of the assessee should be more than 5,000. Non agricultural income of the assessee should be more than the basic exemption limit. Only if all of these three conditions are fulfilled, only then your assessee will be, only then assessee's tax computation will be by way of partial integration method. Okay, so if assessee is having exempt agricultural income and they're asking you to compute tax, then yes, you will think about partial integration method, but you will then check about these three conditions. Only if all these three conditions are fulfilled, only then you will apply the partial integration method. Tell me the three conditions one last time, guys. Condition number 1, assessee should be an individual HUF, AOP, BOY or AGP. Then assessee's net agricultural income should be more than 5,000. I am not saying agricultural income. I am saying net agricultural income, which means agricultural income minus agricultural expenses. And lastly, non-agricultural income should be more than basic exemption limit. Okay. Then comes your next point, your 13th concept. See, if assessee is having rental income from agricultural land, that agricultural land is situated in India and that land is being used for agricultural purposes. Assessee is having rental income from an agricultural land which is in India, which is being used for agricultural purposes. Whether your assessee owns the land, whether your assessee does not own the land, doesn't matter. What matters is assessee is having rental income from an agricultural land in India which is used for agricultural purposes. If these four conditions are fulfilled, the rental income will be considered as if it is agricultural income and it will be exempt under section 10 clause 1. Okay, so these were your 2 points in your agricultural income discussion. Now comes your salaries head. See, under salaries head, I have 5 very important adjustments. Listen to me carefully. The first one especially is very important, section 16. Now under section 16, you have 3 deductions totally. Number 1, 50,000 standard deduction you will get. Number 2, professional tax paid, whether it is paid by employer, whether paid by employee, total professional tax paid you will get as a deduction under section 16. Paid, guys, I am writing the word paid, which means it should be on payment basis. And condition number, and the third section 16 deduction is entertainment allowance. How much will you get? You will calculate 3 things: 5,000 rupees, 20% of basic salary, actual entertainment allowance received. Out of these 3, whichever is lesser will be your section 16 deduction, but of course only for central government and state government employees. Alright, so you have totally 3 deductions under section 16 under the normal regime. The first 2 deductions are for all employees. The third deduction is only for central government and state government employees. But under section 115 BAC, under the default regime, only one deduction you will get under section 16, and that is standard deduction, and that to a higher amount, 75,000 deduction you will get. Okay, so this was your 14th adjustment regarding a salaries head. Then comes your 15th adjustment. This is about interest-free loan or loan at concessional rate of interest. See, this is a taxable perquisite. It's taxable for all employees, specified employees, non-specified employees, doesn't matter. But however, there are 2 situations where this perquisite is exempt. Number 1, if the aggregate original loan is up to 20,000, or number 2, if the loan is for medical treatment of Rule 3A disease. See, this point everybody knows. It is this first point where I have some observations for you. Point number 1, we are supposed to look at the aggregate loans, not each loan separately. Like if the employer has given to the employee 5 loans, you will see all the 5 loans put together, how much is the loan amount. Okay, so aggregate loan and not separate loan. Then you are supposed to look at the aggregate original loan and not the outstanding loan. See, you need the outstanding loan amount to calculate the taxable value of the perquisite. Okay, outstanding loan amount into interest saved by the assessee, that only will be the taxable value of the perquisite. But for this 20,000 number, you don't consider the outstanding amount, you consider the original amount. Original amount means long back when the employer had given the loan, how much loan had he given. Okay, so this interest-free loan, loan at concessional rate of interest, generally it is a taxable perquisite, but you will get exemption in 2 cases. Number 1, if the aggregate original loan is up to 20,000, and number 2, if the loan is for medical treatment of Rule 3A disease. Okay, now coming to your 16th adjustment. How much maximum exemption do you get for retirement benefits? For leave salary, your maximum exemption is 25 lakhs. Gratuity, whether covered by POGA, whether not covered by POGA, 20 lakhs. For retrenchment compensation and for VRS compensation, you have 5 lakhs limit. Okay. Moving on to the 17th point now, when you are calculating leave salary exemption, you need the rate of earned leave entitlement, that is maximum how many days of leave your employee is allowed to take in a year. That should not be more than 30 days. Even if it is more than 30 days, you will restrict it to 30 days. See, you need this number to calculate earned leave, right? To calculate earned leave, you need to know how many days of leave employee is allowed to take in a year maximum. That has to be restricted to 30. That is called as rate of earned leave entitlement. Okay. Then comes coming to the last point in our salaries head, the 18th point. Now this is where the most confusion happens generally. Leave salary, gratuity covered by POGA and gratuity not covered by POGA. Remember, leave salary and gratuity not covered by POGA are more or less similar. Okay. In leave salary, your salary will have three components: basic salary, DA forming part, employees turnover based commission. Same three components in gratuity not covered by POGA, also same three components. In leave salary, when you're computing salary, you will take 10 months average. Same thing in gratuity not covered by POGA, also you will take 10 months average. But the place where mistake happens is here now. See, in leave salary, you will take 10 months average, but 10 months before the date of retirement. But for gratuity, it is 10 months before the month of retirement. Small point, minute point, but it will make a difference in your answer paper. So remember this. So leave salary, it's 10 months before the date of retirement, and gratuity not covered by POGA, 10 months salary before the month of retirement. Okay. In both, in leave salary also, in gratuity not covered by POGA also, in both of them, when you're calculating the number of completed years of service, any fraction you will fully ignore. Whether less than 6 months, more than 6 months, don't bother. Fully ignore the fraction. Okay. Now comes the next point. What if assessee is covered by POGA? So to compute gratuity exemption, if assessee is covered by POGA, salary will have two components: basic salary and all DA. Whether it is forming part, not forming part, doesn't matter. Take full DA. Okay. Basic salary plus full DA. Now here no 10 months average and all. Just take the last run salary. Last run basic salary, last run DA. Here when you are computing the number of completed years of service, if there is a fraction, you will consider the fraction. If the fraction is up to 6 months, you will ignore. If the fraction is more than 6 months, you will round up. Like for example, if the assessee has rendered service for 10 years and 10 months, the fraction is 10 months, it is more than 6 months, so you will round it up to 11 years. So 10 years, 10 months, you will round it up to 11 years. So when you are computing gratuity exemption, if assessee is covered by POGA, yes, you will consider fraction. In leave salary and in gratuity not covered by POGA, you will fully ignore the fraction. In leave salary and in gratuity not covered by POGA, salary has three components. In both you will take 10 months average, but in leave salary 10 months before date of retirement, and in gratuity 10 months before month of retirement. Okay guys, so with this we're done with 18 adjustments. Now let's see 3 adjustments from our IFHP head. The 19th adjustment, this is regarding interest. See, under IFHP head, your most important adjustment is interest, especially pre-construction interest. Guys, do properly and go. See, the biggest mistake that happens in IFHP head is that even though we are aware of pre-construction interest, okay, in the examination it doesn't even strike us that we are even supposed to think about that. So therefore remember, whenever you are doing any question in your examination from IFHP head, when you come to the interest adjustment, you should always think about two things: current year interest and pre-construction interest. And when will you have pre-construction interest? You will have pre-construction interest only if the date of borrowing is before the date of construction completion. Obviously guys, pre-construction interest, no. So the loan should be borrowed before construction got completed. Okay, so the date of borrowing should be before date of construction completion, and the loan should be borrowed either for purchase or for construction of the property. If both these conditions are fulfilled, then yes, you will have pre-construction interest. This was anyways an extra additional discussion. Now listen to my main point over here. We know that interest is a main deduction in IFHP. This interest is allowed on accrual basis. See, in IFHP, it is municipal tax which is allowed on payment basis, which means assessee has to actually pay the municipal tax amount in the previous year. Whatever is paid in the previous year, doesn't matter it belongs to which year. Whatever is paid in the previous year, that much municipal tax you will allow in IFHP head, provided it is paid by assessee, not by tenant. Okay, this point you know. Now see, however, interest is on accrual basis, which means whether you've paid the interest, whether you've not paid the interest, it doesn't matter. On accrual basis, interest is allowed under section 24. And who is a lender? It doesn't matter guys. The lender can be bank, lender can be friend, lender can be director, lender can be money lender, doesn't matter. Lender can be any person. Okay, I'll tell you why the confusion arises. I'll tell you where the confusion arises. See, interest on housing loan is there in 3 places. It is there in IFHP head. Then in chapter 6A you have section 80EE and section 80EA. So totally in 3 places interest on housing loan is covered. In IFHP head, no, over here the interest can be relating to purchase also, can be relating to construction also, can be relating to repair also, just that the loan should have some connection with the property. But in section 80EE and in section 80EA, the loan should be only relating to purchase of property. point number 1. Point number 2, in all the 3 places, the interest is allowed on accrual basis. Okay, but you have one more interest section in chapter 6A, ATE. Education loan, that is only on payment basis, but ATEE, ATEA, ATEEB and all accrual basis only. Point number 3, in IFHP, your lender can be any lender. But in ATEE and ATEA, lender can be either bank or housing finance company, no other lender we are covering. Okay, so that is why understood why I am stressing on these points. So in your IFHP head, yes, interest is allowed, interest relating to housing loan is allowed, but it is allowed on accrual basis, which means whether you've paid, whether you've not paid doesn't matter, and the lender, who is the lender, doesn't matter. Okay, now how much interest is allowed? For let out property, there is no limit. Whether normal regime, whether default regime, for let out property, there is absolutely no limit. The limit is only for self-occupied property. Self-occupied property, you have 2 limits. You have 2 lakhs limit and 30,000 limit. You can apply the 2 lakh limit only if the loan was borrowed on or after 1st April 1999. The loan should be borrowed for purchase or construction of the property, not for repair, not for renovation, not for reconstruction and all, only purchase or construction, and the purchase construction should be completed within 5 years from the end of the year of borrowing. If all these 3 conditions are fulfilled, then 2 lakhs limit will apply. If even one condition is not fulfilled, like for example, if the loan was borrowed before 1st April 1999, or if the loan is borrowed for repair or reconstruction, then the limit will become 30,000. Okay, but however, if you are doing calculation under the default regime, under 115 BAC, self-occupied property, interest itself will not be allowed. So there is no question of limit because interest itself is not allowed under default regime for self-occupied property. So remember, in IFHP head, in the default regime, let out property, no change in computation. Okay, self-occupied property in normal regime, you will always have a negative number. But in default regime, your answer will always be 0 for self-occupied property because interest is not allowed under the default regime for self-occupied properties. Okay, clear guys? 2 important adjustments we've had, also connected it with chapter 6A a little bit for you. Now come to the next adjustment, unrealized rent recovered and arrears of rent recovered. See, yes, we all know that 70% has to be taxed, but there are so many hidden adjustments over here which many of us tend to forget. So I'm just trying to highlight those forgotten adjustments for you. See, both will be taxed when? Both will be taxed in the year of receipt. But in IFHP head, you can tax an income only when assessee owns a property. But this is an exception, guys. Unrealized rent recovered, arrears of rent recovered, it will be taxed in the year of receipt. In the year of receipt, when you are taxing it, even if the assessee does not own the property, doesn't matter. Whether assessee owns a property or not doesn't matter. In the year of receipt, this income will be taxed. Okay, there's one more special point about unrealized rent recovered. Okay, see, when you're computing GAV for let out property, unrealized rent is subtracted in the GAV computation, but it is subtracted only if 4 conditions given in rule 4 are fulfilled. Tenancy should be bona fide, the defaulting tenant should have vacated the property, or assessee should have taken steps to get the property vacated. Then the defaulting tenant should not occupy any other property belonging to the assessee. Then assessee should have instituted legal proceedings against the defaulting tenant. You have 4 conditions. Only if all the 4 conditions are fulfilled, only then you can subtract unrealized rent in GAV computation. Now, if you had not subtracted unrealized rent in GAV computation, then now if you are recovering unrealized rent, it will not be taxed. Are you understanding? Earlier, if unrealized rent was subtracted in GAV computation, only then, now when you are recovering the unrealized rent, it will be taxed for you. Earlier, if unrealized rent was not subtracted in GAV computation because maybe some rule 4 condition you did not fulfill, if it was not subtracted in GAV computation earlier, then now when you are recovering the unrealized rent, we will not tax it. Okay, so 2 special points, guys. Point number 1 is what we all know, that yes, 70% will be taxed in the year of receipt. But in the year of receipt, whether we own the property or don't own the property, that doesn't matter. And point number 2 is about unrealized rent recovered. This will be taxed only if earlier unrealized rent was subtracted in the GAV computation. Okay, so 21 adjustments are over. Now come to your PGBP head of income. The most important adjustment which is highly probable in your examination tomorrow is section 40B. Section 40B which applies to partnership firms and LLP. The firm can be a partnership firm or LLP, doesn't matter. See, totally 2 adjustments over here, interest and salary. Okay, now interest that the firm is paying to partner, whether the partner is an active partner or sleeping partner, doesn't matter. Any interest which the firm is paying to a partner, maximum 12% will be allowed for the firm. Whatever is allowed for the firm will be taxed for the partner. So maximum 12% interest will be allowed for the firm, of course provided the interest is allowed as per the partnership deed as well. Then listen, what if the firm is paying salary? See, if the firm is paying salary to sleeping partner, it will be fully disallowed for the firm, which means nothing will be allowed for the firm. If nothing is allowed for the firm, nothing will be taxable for the partner. Okay, but what if the firm is paying salary to active partner, to working partner? Then you will first find the book profit. Book profit is nothing but normal usual PGBP, guys. As per chapter 4D, consider all PGBP adjustments, consider interest adjustment also, consider unabsorbed depreciation adjustment also, consider all PGBP adjustments just before subtracting salary to partners. Just don't consider one adjustment. Which adjustment? Salary to partners. So ignoring salary to partners, find the PGBP, that will become book profit. If the book profit is up to 6 lakhs, then 90% of book profit or 3 lakh, whichever is higher. If the book profit is more than 6 lakhs, then up to 6 lakhs will be 90% of book profit or 3 lakh, whichever is higher, and on the excess book profit above 6 lakhs, on that excess 60% of the excess. So this will become your maximum allowable salary for the firm. Whatever is allowed for the firm only will be taxable for the partner. So be very smart, okay? If they ask you how much salary is taxable for the partner, you will first have to do computation from the firm's point of view. Find out how much is supposed to be allowed for the firm, and then that much only will be taxed for the partner. Okay, remember, interest doesn't differentiate between active partner, sleeping partner. No differentiation, same provision only. Maximum 12% will be allowed for the firm. Whatever is allowed for the firm is taxed for the partner. But salary only differentiates between active partner and sleeping partner. Any salary paid to sleeping partner, for the firm it will be fully disallowed. Okay, if nothing is allowed for the firm, nothing will be taxable for the partner, obviously. But when it comes to active partner, here only you will have to do all the hard work of computing book profit. Book profit up to 6 lakhs, 90% of book profit or 3 lakhs, whichever is higher, will be allowed. On the remaining book profit, 60% of the excess will be allowed. Both of these put together, this will give you the maximum allowable working partner salary for the firm. Whatever is allowed for the firm will be taxed for the partner. Okay, this was your 22nd adjustment. Now comes your 23rd adjustment. Guys, don't give up right now. You can feel all the tired you want to feel after exam is over. Postpone the tiredness. Come on, sit up straight. Listen to me. The 23rd adjustment is relating to scientific research. Okay, now scientific research, two adjustments we have: in-house scientific research and contribution to outsiders. Now see, in-house scientific research is allowed under both the regimes. Normal regime or default regime doesn't matter. But remember, in in-house scientific research, there is one key point, that the scientific research has to be related to assessee's business. Only then it will be allowed both under normal regime also, under default regime also. And in-house scientific research, one more point, remember, there is one expense which will not be allowed: land will not be allowed. Okay, in section 35 AD, specified business, land, goodwill, financial instruments, 3 expenses are not allowed. Scientific research, only land is not allowed. Okay, so in-house scientific research is allowed under normal regime also, allowed in default regime also, provided it is related to assessee's business. But however, contribution to outsiders, like for example, if assessee is contributing for scientific research or for research in social science or for statistical research to IIT, IIM, National Laboratory Research Association, Indian Scientific Research Company and all, under the normal regime it will be allowed. Whether it is related to assessee's business, not related, doesn't matter. Under normal regime, contribution to outsiders is allowed, but under the default regime it is not allowed. Okay, so under the default regime, in-house scientific research is allowed, only contribution to outsiders only is not allowed. This is your 23rd adjustment. Then comes your 24th adjustment. This is about presumptive taxation. You have 3 presumptive taxation sections, guys. In section 44 AD, 6% of turnover which is realized in specified mode within 139(1)(8). What you will do, I'll tell you, listen to me. You will see what is the turnover of the assessee. Out of the turnover, how much is realized? Realized means what? How much has been recovered by the assessee, in what mode? In specified mode, within which date? Within 139(1)(8). So you will see how much of the turnover has been realized within 139(1)(8) in specified mode. Okay, that turnover into 6% will become your PGBP. Whatever is a balance turnover, whether received, whether not received, when received, how received, I don't care. Whatever is a balance turnover, 8% will be your PGBP. Okay, so these are your 2 points relating to 44 AD. So that's all. These two put together will become the PGBP of the assessee. 44 ADA is for specified professionals. Here the PGBP will be 50% of gross receipts. Alright. In section 44 AE, It depends. 44AE is if assessee is in the business of plying, hiring, leasing goods carriages. That section, guys. Assessee should not own more than 10 goods carriages, right? So under section 44AE, for heavy vehicles, 1000 rupees per ton per vehicle per month or part thereof will be taxable. For other vehicles, 7500 per vehicle per month. Now heavy vehicles means what? Heavy vehicles means the vehicle can carry more than 12,000 kg or more than 12 tons. You will call it as heavy vehicle. So for heavy vehicles, 1000 rupees per ton per vehicle per month. For other vehicles, 7500 per vehicle per month. This will be taxable. But however, in section 44AE, we have a special point. This special point will apply only if assessee is partnership firm or LLP. So if assessee is partnership firm or LLP, section 40B, interest to partners, salary to partners, that also will be allowed. See, in 44AD, 44ADA, no other allowance, no other disallowance. Okay, that's all. This only is PGBP, no other allowance, no other disallowance. In 44AE alone, one allowance we are allowing. What is it? Section 40B, salary to partners, interest to partners. But this will be allowed only if the assessee happens to be a partnership firm or LLP. Okay guys, now see, there's one more point I want to discuss with you. In section 44AD and 44ADA, if assessee is following any of these two presumptive taxations, then in that case, assessee need not maintain books of accounts, guys. Assessee need not get books of accounts audited also, and assessee assessee still has to pay advance tax. Full 100% advance tax assessee has to pay, but entire amount has to be paid only in the last installment, March month installment only advance tax has to be paid. But under section 44AE, if assessee is following this presumptive taxation, here also assessee need not maintain books of accounts. Here also assessee need not get the books of accounts audited. But however, here advance tax, all 4 installments assessee still has to pay. So advance tax leniency you will get only in 44AD, 44ADA. In 44AE, whether you are following 44AE or not doesn't matter. Advance tax you still have to pay in all 4 installments. Okay, so this was about your presumptive taxation. Then listen, taking you forward to adjustment number 25. This is from your depreciation discussion. Okay, see, when you are calculating your block, when you are doing a block computation, there's only one step through which an asset enters the block, and that is add actual cost of assets acquired. Now the question is, at what value will the asset enter the block? See, in case any expenses incurred before the asset is put to use, all those expenses will be added to the actual cost. Like any interest is incurred or any freight is incurred before you put the asset to use, it will be added to the actual cost. Now this everybody knows, but the point which I want to highlight for you is subsidy. In case assessee has received any subsidy to buy the asset, that has to be reduced from actual cost. So whatever expenses are incurred before putting the asset to use, it will be added to the actual cost, but whatever subsidy has been received by the assessee to enable him to buy the asset, the subsidy will be reduced from the actual cost. Okay, now coming to section 40A subsection 2, here 3 simple conditions. Assessee has incurred an expense. The expense is excess or unreasonable, and the other party happens to be a relative. If all these 3 conditions are fulfilled, then whatever is the excess or unreasonable portion, to that extent the expense will be disallowed. Okay, now I'll tell you what mistake happens over here. As soon as students see this word excess or unreasonable, they straight away disallow the expense. There are 2 things. First of all, if it is excess or unreasonable, you can't disallow the whole expense. You will disallow only the excess portion, only the unreasonable portion, that only you will disallow. Second point is, you will disallow only if the other party is a relative. If the other party is not even a relative, then even if it is excess or unreasonable, no disallowance. Okay. Now see, relative means what? Relative means if I am the assessee, then my brother, my sister, my parents, grandparents, great-grandparents and so on, my children, grandchildren, great-grandchildren and so on, and my spouse. Now here very often this adjustment comes in the examination. Okay, like for example, they say assessee has paid a salary to employee 20,000, but the market rate is only 15,000. So excess salary of 5,000 has been paid, and that employee happens to be the brother-in-law of the assessee. See, has assessee incurred an expense? Yes, salary expense. Is the expense excess or unreasonable? Yes, 5,000 is excess or unreasonable. But is it other party relative? Other party is brother-in-law. Is brother-in-law covered over here? No. Is spouse's brother covered in this entire relative discussion? No. So brother-in-law is a very popular adjustment they give over here to confuse you regarding section 40 subsection 2. Remember, relative over here is only plus spouse with arrows. You will not forget. Okay, so these are your 26 adjustments. Now let's come to the capital gains chapter. See, in capital gains, point number 1, if it is slump sale, then in that case, whether the transfer happened before amendment, after amendment, doesn't matter. Period of holding will be 36 months only. Okay, see, did you listen to what I said? I'll repeat again. Slump sale extremely important because of this point. Okay, in slump sale, cost of acquisition, cost of improvement and all will be nothing but the net worth of that particular unit. In slump sale, you are transferring your entire unit for lump sum consideration. Now see, in capital gains chapter, you know that there is an amendment. If the date of transfer is before 23rd July 24, old provisions apply. If the transfer happened on or after 23rd July 24, the new provisions apply. In the new provisions, you have only 2 periods of holding, 12 and 24. In the old provisions, you have 3 periods of holding, 12, 24 and 36. Okay, so in the new provision, you don't even have 36 months, but exception is slump sale. For slump sale, whether the transfer happened before amendment or after amendment doesn't matter. The relevant period of holding is 36 months, which means if the assessee owned the unit for less than or equal to 36 months, then it's going to be a short-term capital asset, short-term capital gains. But if the assessee held the unit for more than 36 months, then it will be long-term capital asset, long-term capital gains. Okay. This was your 27th adjustment. Then comes your 28th adjustment regarding section 50AA. Now under section 50AA, before the amendment, there were only 2 assets, market linked debentures and units of debt oriented mutual fund. But on or after 23rd July 24, inside section 50AA, we have 4 assets now. We still have the old assets, market linked debentures and units of debt oriented mutual fund. We have 2 more assets now, unlisted bonds and unlisted debentures. Now what is the speciality of section 50AA? See, whatever asset is covered under section 50AA, I will not even do the hard work of checking the period of holding, guys. It will always be short term only. Getting it, guys? So before amendment, there were only 2 assets in 50AA. After amendment, we have 4 assets in 50AA. If your asset is getting covered in 50AA, then you will not even check the period of holding. It will always be short term only. And if short term, anyways no indexation, guys. See, after amendment, anyways no indexation. Even before amendment, if it is short term, then no indexation. Indexation is only for long term assets. So if it is section 50AA asset, then irrespective of the period of holding, it will always be short term only, and if short term, obviously no indexation. Okay, now listen, where else do we say that the capital gains will always be short term only? We say this in depreciable assets also. Here also, if at all you have capital gains, like for example, if the block is empty, it will either be short-term capital gain or short-term capital loss only. One more point is there. I'm not sure if you know about this. Self-generated intangibles. If assessee is having any self-generated intangible asset, even over here, the capital gains will always be short-term only. Okay. Then comes your 29th adjustment, section 112. See, this adjustment I want to discuss a little extensively with you. In your capital gains head, okay, you have totally 3 sections, 3 taxation sections. Number 1, you have section 111A for STCG. Your STCG will either be 111A STCG or normal rate STCG. Then for long term, you have section 112 and section 112A. Okay. Now, what are your tax rates under each of these sections? Let me tell you. See, in case a transfer happened before the amendment, before 23rd July 24, under 111A, your tax rate was 15%. But if the transfer happened on or after 23rd July 24, your tax rate has become 20%. Okay. Then in section 112, your tax rate before amendment was 20%. But however, if the transfer happened on or after the amendment, then your tax rate has been reduced to 12.5%. Okay. Then under 112A, your tax rate before the amendment was 10%. But if the transfer happened on or after the amendment, then your tax rate has been increased to 12.5%. This is how your tax rates are in capital gains. But however, guys, notice that in section 112, okay, if the transfer happened before adjustment, no complication, straight away 20% tax rate, story over. But under section 112, if the tax rate happened on or if the transfer happened on or after the amendment, in that case, if the 4 conditions are fulfilled, then your tax rate will be either 12.5% without indexation or 20% with indexation, whichever is lesser. So when will all this drama apply? First of all, only under section 112, and that too only if the date of transfer is on or after the amendment. Understanding? So if the date of transfer is on or after the amendment, then under section 112, I will check 4 conditions. Condition 1, is your assessee a resident individual or HUF? Condition number 2, is the capital asset immovable property? Condition number 3 is the date of acquisition before amendment and date of transfer on or after the amendment. If these 4 conditions are fulfilled, only then you will do 2 computations for tax, 20% with indexation, 12.5% without indexation, and whichever is lesser is what you will pick, that is what your assessee will pay. See, at this stage, I want you to put one point very nicely in your memory, and that is, you will do 20% with indexation, 12.5% without indexation, all this only in tax computation. Your LTCG number, your capital gains computation number will not change. See, the reason is on or after the amendment, you anyways don't have indexation. So, when you're doing capital gains calculation, it will be without indexation only. So, in capital gains calculation, don't do with indexation, without indexation, whichever is lesser. Don't do in capital gains calculation. No, this section 112 is a tax computation section. It's not a capital gains computation section. Understanding? So, after the amendment, capital gains will be without indexation only. But only and only for tax computation purpose only. For that purpose only, you will do 20% with indexation or 12.5% without indexation, and you will pick whichever is lesser. But notice, you will do all this drama only under section 112. Only if the transfer happened after the amendment. Only if these 4 conditions are fulfilled. Okay, this was your 29th adjustment. Nice capital gains revision happened through this adjustment. Then comes your 30th adjustment. Let me come to this one first. Okay, section 112A. Just now I spoke to you about 112A. 112A is that, guys, listed equity shares, STT paid, that one. 112A, if the transfer happened before the amendment, then your tax rate is 10%. If the transfer happened on or after the amendment, then the tax rate is 12.5%. Okay. Now, in section 112A, when you're computing tax, you will get 1,25,000 exemption. Again, same thing I'm telling you. 112A is not a capital gains computation section. No. It is a tax computation section. So, you will give all this exemption only at the time of computing tax, not at the time of computing capital gains. In capital gains computation, don't say 1,25,000 is exempt. It will become terribly wrong. Give the exemption only while computing tax. Okay. So, whether the transfer happened before amendment, whether the transfer happened after amendment, you will give 1,25,000 exemption for 112A cases. 112A, you will find the tax first. Like, let's say the tax is 1,50,000. Okay, so 1,25,000 of the tax will be exempt. So assessee will have to pay 25,000 tax only. Okay, up to 1,25,000 exempt. Beyond 1,25,000, whatever is the excess tax, that only assessee has to pay. Okay, then comes your next adjustment over here. In case assessee has any unutilized basic exemption limit. See, if whatever basic exemption limit we have, we will always first adjust it against normal rate income. Okay, if any basic exemption limit is still remaining unutilized, okay, the unutilized basic exemption limit can be adjusted against 111A STCG, any LTCG, it can be adjusted, but it can be adjusted only if assessee is resident. Now, you know where mistake is possible over here, this point. You should not straight away adjust the unutilized BEL over here. You should utilize only if assessee is a resident. Okay, so with this 31 adjustments over, guys, come on, let's not break the flow. Let's go into the IFOS head. I have 5 interesting adjustments for you here also. Let's see them one by one. The 32nd adjustment is about family pension, important amendment, guys. See, family pension in IFOS head, understand, if your assessee is an employee, retired employee, okay, retired employee got pension, it will go into the salaries head. Alright, and in case the question says that assessee got pension under bravery awards, and under bravery awards, like for example under Mahavir Chakra, under Paramveer Chakra, under any of these bravery awards, if you get any pension income, that will be fully exempt under IFOS. Okay. In case the employee has died and after his death, if his family is receiving pension, that is called as family pension. It will come under the IFOS head. Now, this family pension under the normal regime, 1/3 of the pension received of 15,000, whichever is lesser will be your deduction. But under the default regime, same 1/3 of pension received, but instead of 15,000, it will be 25,000, guys. Okay. So, under the normal regime, 1/3 of pension or 15,000, whichever is lesser will be deduction. Under the default regime, 1/3 of the pension regime or 1/3 of the pension received or 25,000, whichever is lesser will be your deduction. Okay, then listen, 33rd adjustment. This is an extremely important adjustment. Listen carefully. You all know this. I just want to remind you about this. See, Under gifts, you have movable gifts and immovable gifts, right guys? Those gifts you will tax under IFOS only if the gifts are first of all capital asset in the hands of the recipient. Like for example, if the gift happens to be a watch, or if the gift happens to be a television, or if the gift happens to be a refrigerator, or if the gift happens to be a car, it is all movable asset, but none of this is capital asset. They are all personal effects, guys. So if they are personal effects, that is, if they are not capital assets, they will not be taxed under the IFOS head. They will not be taxed anywhere itself. Ignore, simply ignore. Okay. Similarly, if the gift happens to be a rural agricultural land, it is not a capital asset. So if it is not a capital asset, you will not tax it under IFOS. But be careful, if the question says rural land is a capital asset. This will get taxed under IFOS. Okay, so stay very vigilant over here. Only if it is rural agricultural land, only then you will say it is not a capital asset. If it is rural land, it is a capital asset. And if it is a capital asset, welcome to IFOS. Okay, so under gifts for the recipient, the gift should be a capital asset. If it is movable asset or if it is an immovable asset, it should be a capital asset for him. If it is a personal effect, if it is rural agricultural land and all, it is not a capital asset. If it is not a capital asset, then no IFOS. Okay, then listen, any interest income from government securities will be taxable. Under IFOS, fully it will be taxable. But if the question says it is notified government securities, then the interest income will be exempt. Okay, then post office savings interest, you will get 3,500 exemption. Now this exemption, lot of times students are confused. This exemption is under both the regimes, guys. Whether assessee is following the normal regime, whether assessee is following 115 BAC, doesn't matter. This 3,500 exemption is under both the regimes. But don't forget to also give 80TTA, 80TTB deduction as the case may be. Okay. Then any advance money forfeited by the assessee before 1st April 2014, you will reduce it from the cost of acquisition. But any advance money forfeited on or after 1st April 2014, you will straight away tax it in the under the IFOS head in the year of forfeiture itself. Okay. So 5 adjustments I have discussed with you from your IFOS adjustment. Now let's go to your clubbing chapter. 2 points over here. Point number 1, in case minor child has earned any income, under the normal regime you should remember to give 1,500 exemption per child. Here there is no limit on the number of children. It can be less than 2, more than 2, doesn't matter. Per child 1,500 exemption you should give. Under the default regime, this exemption is not available. Now what mistake happens over here, I'll tell you. See, listen to me. Let us say the assessee is having a minor child. Okay, the minor child, there are assessees having 2 minor children, minor child 1, minor child 2. Minor child 1's income is 10,000 rupees, which is being clubbed with assessee's income. Minor child's 2 income is 1,000 rupees, which is being clubbed with assessee's income. So total, how much is a minor children's income which is being clubbed? 11,000. How much section 1032 exemption you will get? 1,500 for one child, 1,500 for the second child, total 3,000. Like this you should not do. What is a mistake over here? See, you should always do this calculation for each child separately. Like first child income is 11,000, you will give 1,500 exemption here. Second child income is 1,000. So if income is 1,000, only 1,000 exemption only you can give. No, how you can give 1,500 exemption? You understood what mistake is possible over here. So be careful, do for each child separately. Okay, same reason why I say children education allowance, children hostel allowance also you should do for each child separately and not aggregate. Okay, so minor children's income you will get 1,500 exemption per child, but no limit on the number of children, and this exemption is only under the normal regime, not under the default regime. Okay. Then comes your next adjustment, your 38th adjustment. If assessee transfers house to spouse, you will not apply clubbing provision because deemed owner concept, section 27 will apply instead. But if assessee transfers house to minor child, here also same thing, clubbing provision will not apply because deemed owner concept will apply. Now minor child, if deemed owner concept is applicable, then this 1032 exemption of 1,500 rupees you will not get, because 1,500 exemption you will get only under clubbing provision and not under deemed owner provision. Okay, but if assessee is transferring house property to minor married daughter, deemed owner concept will not apply. So automatically clubbing concept will apply. And if clubbing concept is applicable, minor child clubbing concept, of course you will give 1,500 exemption provided the assessee is following the normal regime. Understood. Very interesting point. So if assessee is transferring house to spouse, deemed owner concept will apply, clubbing concept will not apply. But what if assessee and spouse, what if they have an agreement to live apart? Then neither deemed owner concept will apply nor clubbing concept will apply. Similarly, if assessee is transferring house to minor child, deemed owner concept will apply, not clubbing. But if assessee transfers to minor married daughter, then deemed owner concept will not apply. So automatically clubbing will apply. And if clubbing applies, you will get 1500 section 1032 exemption. Okay, then coming to your set off and carry forward chapter, your 39th adjustment about loss from house property. Under the normal regime, if you have loss from house property, you can do intra-head also, you can do inter-head also, you can carry forward also, you can bring forward also, you can do everything. But inter-head you can do maximum 2 lakhs only. Okay, but under the default regime, intra-head adjustment only you can do. If you are not able to do intra-head, no, you can't do inter-head. You can't carry forward to the next year. You can't bring forward from the last year. That's all. Loss will lapse. Only intra-head is allowed. So under the normal regime, you can do everything. Only thing, inter-head maximum 2 lakh only. That's the only point. But in default regime, you can do only intra-head. If you're not able to do intra-head, that's all. Forget about the loss will lapse. No carry forward also, no bring forward also. Okay. Then comes your 40th adjustment. This is extremely important. See, if assessee is having a specified business 35 AD, guys, the specified business may be eligible for 35 AD, may not be eligible for 35 AD. If, like for example, if it's a specified business, but it's an old specified business, or if the business is made up of second-hand machinery, lot of second-hand plant and machinery, then it will not be eligible for 35 AD. So I am talking about that specified business where assessee has claimed 35 AD. Okay, and in that business assessee is having loss. So specified business where assessee is claiming 35 AD, there assessee is having a loss. Now this loss can be adjusted against income from any specified business, whether assessee is claiming 35 AD or not, doesn't matter. Any specified business indicates just that it should be specified business. Whether assessee is claiming 35 AD over there, whether assessee is not claiming 35 AD over there, doesn't matter. So if assessee is having specified business loss where assessee is claiming 35 AD, that loss can be adjusted against income from any specified business, whether assessee is claiming 35 AD, not claiming 35 AD, does not matter. And in case assessee is not able to adjust this loss, then this loss can be carried forward. It can be carried forward indefinitely, of course provided ITR is filed on time. Okay, so these were your 2 points in set off and carry forward, one from loss from house property and the other from your specified business loss. Now comes your next set of adjustments from chapter 6A. See, don't lose your patience, we're almost towards the end, guys. We have 10 adjustments left, listen to me carefully. In chapter 6A, first of all, I want to discuss with you about ATTTA and ATTTB. These are those 2 adjustments which come very often in the exam. Like 99% this one out of these 2 adjustments will be there somewhere or the other in your question paper. But even though it is this repetitive, students make a lot of mistakes over here. So therefore, I've brought a nice comparative analysis of these 2 sections, guys, so that we can eliminate the chance of making mistakes. First, let's discuss these sections one by one. See, out of these 2 sections, we all know that ATTTB is beneficial because here we get 50,000 deduction, whereas in ATTTA we get only 10,000 deduction. So first, we will always try ATTTB. Now, in ATTTB, your assessee has to be a senior citizen or a super senior citizen, which means assessee has to be an individual, assessee has to be a resident, and at least 60 years assessee has to be. So under section ATTTB, assessee has to be senior citizen or super senior citizen, and we are covering interest. Interest can be can be savings account interest, it can be FD interest, it can be RD interest, it can be any of these 3 interests. But however, the interest has to be from BCP, which is bank, cooperative bank or post office. NBFC and all is not covered over here, and the maximum deduction you will get is 50,000 rupees. Okay. If section ATTTB is not applicable for you, then only you will come to ATTTA. So ATTTA will apply to which assessee? Number 1, ATTTA will apply for HUFs. Number 2, ATTTA will apply to those individuals for whom ATTTB was not applicable. Okay. In ATTTA, only savings interest only we are covering, no FD interest, no RD interest, and here maximum 10,000 rupees reduction you will get. Okay, so these are these two sections. Now let's try to compare. See what is common between the two. In both of them I am covering interest income from BCP, bank, cooperative bank and post office. Okay, but what are the differences? Difference number one, in ATTTA maximum deduction is 10,000, ATTTB maximum deduction is 50,000. In ATTTA we are not, in ATTTA we are covering HUF also, but in ATTTB we are not covering HUF, only individual we are covering. Then in ATTTA, assessee has to be senior citizen, super senior citizen. No, only resident can be senior or super senior citizen. So only resident we are covering in ATTTB, but ATTTA no rule like this. So in ATTTA, assessee can be resident or non-resident, it doesn't matter. Then in ATTTB, we are covering savings interest also, FD interest also, RD interest also, all the three we are covering. But in ATTTA, we are covering only savings account interest. Okay, so do not make a mistake over here, don't get confused between the two, carefully see which is applicable. First always try, remember the simple tip, first always try ATTTB. Only if ATTTB is not possible, only then come to ATTTA. Okay everybody, alright, so this was your 41st adjustment. Then comes your 42nd adjustment. See, if assessee is following the default regime 115 BSc, then assessee will not get chapter 6A. But these three sections assessee can still enjoy: 80JJAA, 80CCD2 and 80CCH subsection 2. Now don't get confused between this list and chapter 6A part C. In your syllabus, chapter 6A part C, three sections you have, and that is 80JJAA, then 80QQ B and 80 RRB. So don't get confused between these two lists. Now see, let's talk a little bit more in detail about 80 CCD subsection 2. See, 80 CCD covers NPS contributions, National Pension Scheme, Atal Pension Yojana, New Pension Scheme, whatever you want to call it. Now NPS Tier 1 account is covered in 80 CCD. If the assessee is contributing to Tier 2 account, it will go to section 80C, but only if assessee is a central government employee. If assessee is contributing to Tier 2 account, and if assessee is not a central government employee, then neither will 80C apply nor will 80CCD apply, no section will apply. Okay, anyways, let's focus on 80CCD subsection 2. 80CCD subsection 2 covers employers' contributions. Now, employers' contributions under the normal regime, you will get maximum 10% of salary. This is your maximum deduction under 80CCD subsection 2. But if employer is central government, state government, then maximum 14% of salary you can enjoy. But however, under the default regime, doesn't matter who your employer is, central government, state government or any other employer, doesn't matter. Under 80CCD subsection 2, maximum 14% of salary you can enjoy under the default regime. Okay, so see, one small revisionary point I'll tell you at this stage. Okay, in your syllabus, because of 115 BSc, generally I take away all benefits from you. Like for example, HRA allowance I will take away from you. Your section 35 AD deduction I will take away from you. So because of 115 BSc, generally benefits are snatched away from you. Okay, but because of 115 BSc, there are three places where you will get extra benefit. One is standard deduction in salaries. Generally only 50,000, but under 115 BSc you will get 75,000. Then the second place is family pension. Family pension maximum deduction you will get 15,000. No, 1/3 of pension received of 15,000, whichever is lesser under the normal regime. But under 115 BSc it is 1/3 of pension received or 25,000, whichever is lesser. So not 15,000, 25,000. Even this is an extra benefit. Third extra benefit is in 80CCD subsection 2. 80CCD subsection 2, generally how much deduction will you get? 10% of salary only maximum deduction you will get. Only if employer is central government, state government, only then your maximum deduction will be 14% of salary. But however, if your assessee is following 115 BSc, irrespective of who the employer is, under 80CCD2 you will get 14% of salary deduction. So because of 115 BSc, generally you give up benefits, but in these three places only you will get extra benefits. Okay, very interesting point. I am hoping nicely you are listening to me. Okay, now see, let me take you forward to the next discussion. So we are done learning under chapter 6A. Number 1 about ATTTA and ATTTB. Remember, out of these two sections you will always try ATTTB first. Only if ATTTB is not possible, only then you will try ATTTA. Okay, then after this we discussed if assessee is following the default regime, then chapter 6A will not be allowed, but however 3 sections in chapter 6A I will still allow. 80JJAA, 80CCD subsection 2, 80CCH subsection 2. 80CCD subsection 2, if you see, it's covering employer's contribution to NPS Tier 1 account. If it is Tier 2 account, first of all, in Tier 2 account, only employee's own contribution is covered, and that too only if assessee is a central government employee, and that too only in section 80C. If assessee is contributing to Tier 2 account, if assessee is not a central government employee, 80C also will not apply, 80CCD 2 also will not apply, no section will apply. See, to eliminate confusion, listen to me. If assessee is contributing to Tier 1 account, okay, doesn't matter what kind of employee, central government, state government, not a government employee, doesn't matter, it will come to section 80CCD only. Okay, if assessee is making a contribution to Tier 2 account, you will see is the assessee central government employee. If yes, go to section 80C. If the assessee is making a contribution to Tier 2 account, but if assessee is not a central government employee, then no deduction under any section. Now no confusion. Okay guys, now come on, let me take you forward to the next adjustment. Let me take you to the TDS adjustments now. Under TDS, two sections I want to discuss with you, 194N and 194IA. 194N applies to cash withdrawals, right? So if you are an account holder and if you are withdrawing cash from your own account from BCP, that is bank, cooperative bank or post office, at the time of withdrawal, BCP will deduct tax under section 194N. At what rate will they deduct tax depends upon is the account holder a defaulter or not a defaulter. Defaulter means what? Defaulter means leave the immediately preceding previous year and see 3 years before that. In the 3 years, in 3 preceding previous years, assessee has not even filed ITR. So XXX, he is a defaulter max. He has not even filed ITR. Not even 1 year he has filed ITR in the last 3 years. If your account holder is a defaulter like this, then up to 20 lakhs cash withdrawal, no TDS. Cash withdrawal more than 20 lakh up to 1 crore, 2% TDS, 2% of the excess, and above 1 crore, 5% of the excess. 194N, the most special point is that here the TDS is calculated as a percentage of the excess. Excess means what? Like if you are withdrawing 30 lakhs, then TDS will be only on the excess above 20 lakhs, that is only on 10 lakhs. Okay, so up to 20 lakhs, no TDS, 20 lakh to 1 crore, whatever is excess above 20 lakh on that 2% TDS. If the withdrawal is more than 1 crore, I will see what is a withdrawal over and above 1 crore in excess of 1 crore on that 5% TDS. Okay. But however, if the account holder is not a defaulter, which means 1 year at least he has filed ITR, leave the immediately preceding previous year, see 3 preceding previous years before that, 1 year at least he has filed ITR. If that is the case, then your account holder is not a defaulter. If he is not a defaulter, then up to 1 crore there will be no TDS. More than 1 crore if you withdraw, whatever is the excess on that 2% will be the TDS. So the most special point about 194N is that it is only on the excess. And one more special point I will tell you. See, in case I am having multiple accounts in the same bank, you will find the total withdrawal, aggregate withdrawal of all my accounts in that particular bank. But in case I am having an account in multiple banks, you will do calculation for each bank separately. Understanding, like if I am having multiple accounts in the same bank, like in same HDFC, in one bank HDFC, I am having aggregate accounts, like I am having multiple accounts, like one savings account, one current account, I am having multiple accounts. So in that case, you will see HDFC, all the accounts put together, you will see how much I withdrew. But if I have an account in multiple banks, like HDFC I have an account, Canara Bank I have an account, SBI I have an account. If I have an account in multiple banks, then each bank separately you will check, not aggregate. Okay, but inside one bank if I have multiple accounts, you will find the aggregate of all the accounts put together. Then comes your 44th adjustment. One more section I want to discuss with you under TDS, and that is section 194IA. Now, 194IA will apply if you are buying an immovable property, land, building or both. It should not be by way of compulsory acquisition. Assessee should be buying an immovable property, and it can be any movable property other than rural agricultural land. I am excluding rural agricultural land. It can be urban agricultural land, but it should not be rural agricultural land. The transfer should not be by way of compulsory acquisition, because compulsory acquisition you have a separate section altogether, 194LA. Okay, so there is this person is buying an immovable property, land, building or both, and it is not urban agricultural land, and the transfer is not by way of compulsory acquisition. In such cases, 194IA will come into the picture. We will see what is a consideration or STV, whichever is higher. If it is at least 50 lakh rupees, then TDS will be applicable at the rate of 1%. 1% of what? Same thing guys, consideration or STV, whichever is higher. Now what are the mistakes possible over here? Mistake number 1. Even equal to 50 lakhs is covered. Not just more than 50 lakh, even equal to 50 lakh is also covered. Point number 2. For checking the 50 lakh limit also, for calculating TDS also, for both the purposes you will consider the higher number. Okay. Point number 3. Compulsory acquisition. If the transfer is by way of compulsory acquisition, you should not apply this section. Instead, you should apply 194 LA. Okay. Point number 4. In case there are multiple buyers, then will you look at the 50 lakh limit per buyer? The answer is no. If there are multiple sellers, like joint sellers, will you apply the 50 lakh limit per seller? No. The 50 lakh limit is per property. Then comes your 45th adjustment regarding section 206C1. This is one section from your TCS discussion. 206C1 will apply first of all if the goods are atoms. A stands for alcoholic liquor for human consumption. T stands for tendu leaves. Another T stands for timber, O stands for other forest produce, M stands for minerals like iron ore, coal, lignite, and S stands for scrap. Okay. So if the goods happen to be any of these, then in that case, section 206C1 will apply. So condition number 1, goods should be atoms. Condition number 2, seller should be an R hijack seller. R hijack seller means either the seller will be an individual or HUF, or the seller will be any other person. If he is individual or HUF, his preceding previous year turnover has to be more than 1 crore, or his preceding previous year gross receipt has to be more than 50 lakhs. Okay. So R hijack is just a term which I use in class. If you've attended any of my classes before, you would be knowing what this is. But if you're a new student, then R hijack seller means I'm targeting these sellers. Then condition number 3, buyer should not have given declaration under 206C1A. See, if buyer gives a declaration under 206C1A, then TCS will not apply under any section. Nor will 206C1 apply, nor will 206C1H apply. TCS at all will not apply. Okay, so buyer should not have given 206C1A declaration. Okay. If all these conditions are fulfilled, then 206C1 will apply. At what rate now? See, on this tendu leaves, the TCS rate will be 5%. Okay. On timber and other forest produce, the TCS rate will be 2.5%. Everything else, the TCS rate will be 1%. Okay. Then comes my next discussion about AMT. See, whenever you are doing computation of tax under the normal provisions, not 115 BSE, under the normal regime, whenever you are computing tax, your tax computation is not complete till you think about AMT. Now, when will AMT apply? AMT will apply only if two conditions are fulfilled. Either assessee must be having 10 AA or 35 AD or Chapter 6A Part C, at least one out of these three things assessee must be having, and second condition is if assessee is individual HUF, AOP, BOY, AJP, the adjusted total income should be more than 20 lakh. Adjusted total income means your total income, add back 10 AA, add back Chapter 6A Part C, add back section 35 AD. If you are reversing 35 AD, on the 35 AD asset, give me depreciation. Okay, so this is going to be your adjusted total income number. If AMT is applicable, your tax rate will be 18.5%. Special rate, casual income and all, I don't care. Straight away, whatever is your total income, whatever is your adjusted total income, that into 18.5% will become your basic tax. Of course, surcharge, marginal relief, cess, all that will apply, but no special rate income, normal rate income, nothing. Whatever is your adjusted total income, this into 18.5% will become your tax. Okay. Now, assessee will have to pay AMT or normal income tax, whichever is higher. I am repeating again. This provision will not apply in 115 BSE. It will apply only in normal regime. And don't wait for examiner to tell you also apply AMT. Examiner will not say like that. Whenever examiner is asking you to compute tax, if you are computing as per the normal regime, it is your business to check that AMT is applicable or not. So AMT or normal income tax, whichever is higher, assessee will have to pay. Okay, then comes your next adjustment, advanced tax. See, if the question asks you to compute advanced tax, don't straight away start computing. First check this. Check, is your assessee's assessed tax less than 10,000? Or is assessee senior citizen or super senior citizen not having PGBP? Out of these two, if any out of these two situations exist, then advanced tax itself will not apply. What are the situations? Either assessed tax should be less than 10,000. Now, what is assessed tax? You will find your tax liability. You will subtract TDS credit, you will subtract TCS credit, that's all. You will get your assessed tax. If this assessed tax number is less than 10,000, not up to, I am saying less than. So not less than or equal to, less than, only less than I am saying. If assessed tax is less than 10,000, or if the assessee is a senior citizen or a super senior citizen not having PGBP, out of these two, if any of these two situations exist, then advanced tax will not apply. This is your 47th adjustment. Then comes your next adjustment, your 48th adjustment about your 139(1) due dates. See, you always go in this sequence, okay. First write 30th November 25. This will apply only if assessee is having specified domestic or international transactions, that is transfer pricing assessees. If 30th November 25 is not applicable, then you will try 31st October 25. This will apply for all companies. It will apply for all audit assessees, and if for the firm, if audit is applicable, the firm will become audit assessee. So for the firm, 139(1) date will be 31st October. That firm's partners, whether active partner, whether sleeping partner, for that firm's partners also the 139(1) date will be 31st October. Okay. Then after this, if none of these two dates are applicable, then in that case 31st July will be the date for all other assessees. Okay. Then comes your next adjustment under your return of income, your for which assessee ITR filing is mandatory. It is mandatory to file ITR for which assessees? Number one, for all companies, whether dormant company, active company, small company, listed company, doesn't matter. All companies have to file ITR. All firms, all partnership firms, LLPs also have to file ITR. For individuals, HUF, AOP, BOY, AJP, for these people, you have 11 situations. If assessee fits under any of these 11 situations, then ITR has to be filed. First situation, GTI, add back 54 series exemption. Is it more than BEL? Second, is assessee and ROR having capital asset outside India? Point to be noted, it should be capital asset. Like if I am having a car outside India, I will not get covered over here because car is not a capital asset. I should have a capital asset outside India, like shares or a house. You are understanding? I should have a capital asset outside India. Then condition 3, ROR who is having an agent outside India. Then situation 4, if total deposit in current account is more than 1 crore. Then if total deposit in savings account is at least 50 lakhs. Total electricity expense more than 1 lakh. Total foreign travel expense more than 2 lakhs. If assessee is carrying on a business and turnover is more than 60 lakhs, or if assessee is carrying on a profession and gross receipt is more than 10 lakhs, or if assessee is a senior citizen or a super senior citizen with TDS TCS credit at least 50,000, or not a senior citizen or a super senior citizen but TDS TCS credit is at least 25,000. So you have 11 situations. If assessee fits under any one out of these 11 situations, then assessee will have to mandatorily file ITR. Then comes your 50th adjustment, your last adjustment. What if assessee does not file ITR on time? Consequences of not filing ITR on time, that is, what if your assessee files ITR late? If your assessee files ITR late, then there will be 5 consequences. Consequence number 1, assessee will not be able to carry forward current year losses. Consequence number 2, Chapter 6A Part C you can't enjoy. Part B you can enjoy, only Part C you can't enjoy. Condition 3, consequence number 3, 234F fees has to be paid. How much? If total income is up to 5 lakh, then 1000 rupees. Total income is more than 5 lakhs, then 5000 rupees. Consequence number 4, 234A interest 1% per month or part thereof will have to be paid for the delay period. Consequence number 5, if assessee files ITR late, assessee the computation has to be as per 115 BAC only, which means if you file ITR late, the computation of income can't be as per normal regime. It has to be as per 115 BAC only. And consequence number 6, section 10AA, SEZ unit will not be available for you. Section 10AA deduction will not be available for you. So 6 consequences, guys. So if assessee does not file ITR on time, these will be the 6 consequences. These are your 50 adjustments, guys. But before I close this, I want to point out 2 more things which you will ensure you do properly on your own. One is 10AA and the other is in your returns chapter. You have this concept of verification of ITR, that who should verify the ITR. Like if HUF karta, If Karta is not able to verify, then any adult member, male or female. Then for political party CEO, that verification of ITR, ensure you do properly. 10AA also do properly. Okay, so that's it guys, but before I close, I'll just give you some final reminders from my side, and with that I'll close. Just 4 final reminders. Point number 1, if assessee has a unit in SEZ, immediately section 10AA will come to your mind. But don't forget to tax the net profit from this business into your PGBP head. Second reminder, if your assessee is having specified business, immediately 35 AD will come to your mind. But same thing, don't forget to tax the net profit of that business in your PGBP head. Third reminder, if assessee is having royalty income, immediately 80 QQB, 80 RRB will come to your mind. But don't forget to tax royalty income in IFOS head first. And your last reminder, if assessee is having FD interest, savings interest and all, immediately 80 TTA, 80 TTB will come to your mind. But don't forget to first of all tax these incomes in your IFOS head. Okay guys, that's it. I think this video came out much better than what I expected. The coverage was quite a lot of things you must have, newly learned through this video. Don't get overwhelmed if you had some new learnings. Don't think, oh, I am so close to the exam, I still have so much more to learn. Don't think like that. Instead, be glad that you were able to cover all this before your examination itself. So now if any of these adjustments come in your examination, you're going to be so comfortable. Alright guys, with this I'll close. Ensure you do your examination as nicely as you can without any silly mistakes. Bye-bye.